Does quantitative easing cause asset inflation? Imagine a central bank printing money like a giant faucet, pouring liquidity into the economy. That's essentially what quantitative easing does. It's a policy where a central bank buys government bonds and other financial assets to boost the money supply. The goal is to lower long-term interest rates, making borrowing cheaper for businesses and consumers. When the central bank purchases these assets, the sellers get cash, which they often reinvest into stocks, real estate, or corporate bonds. This increased demand pushes up the prices of these assets. Asset inflation is when the prices of financial assets like stocks, bonds, real estate, and commodities go up faster than usual. Unlike typical consumer inflation, which affects everyday goods and services, asset inflation is driven by more money chasing fewer assets. When central banks implement policies like quantitative easing, they flood the market with money, making it easier to buy assets. This increased liquidity tends to boost demand for assets, which then raises their prices. Lower interest rates from quantitative easing make bonds less attractive because they offer lower yields. Investors, seeking higher returns, shift their money into riskier assets like stocks and real estate. This shift increases demand and pushes prices higher. For example, if government bond yields drop from 3% to 1.5%, investors might buy more stocks or invest in real estate to get better returns. This process can make asset owners wealthier, encouraging more spending and investment. However, the link between quantitative easing and asset inflation isn't always straightforward. If banks hold onto the cash instead of lending it out, or if investors are cautious, the effect on asset prices can be muted. The scale of the easing program also matters. Larger programs tend to have a bigger impact on asset prices. In some cases, asset inflation from quantitative easing can support economic growth by boosting wealth and spending. But it can also widen the gap between the rich and the poor, since those owning assets benefit more. If asset prices rise too far beyond their fundamental values, it can lead to bubbles that might burst later. So, in simple terms, quantitative easing does cause asset inflation by increasing liquidity and lowering interest rates. This makes assets more attractive and pushes their prices up. It's a way central banks influence the economy beyond just controlling consumer prices.